We continue with our discussion on taxation, and in this particular case we're going to look at income from house property. That's the second header of income that we're going to consider. Now this head deals with rental income earned or even that could be earned from a house property, right? So you buy a home, you can either stay in it, so you could stay in it, or you could rent it. Now if you stay in it, let's first divide it in two parts. You stay in it or you do not stay in it. If you do not stay in it, you could rent it, or it might be just lying vacant. So there could be three situations. You are staying in it, you have rented it, or it could be lying vacant. Correct? Now, in each of these three situations, there is some sort of a income from house property that is going to come. And what is important in this case is that typically a house is bought with a home loan in India, and on a home loan you're going to pay an EMI. This EMI, if you remember, is going to be a combination of the principal plus the interest. Now, various amounts of principal and interest can actually come up as some sort of a tax discount that is given to people. In general, for encouraging home ownership, there are some benefits of home ownership in the taxation perspective in India. Let's understand those. Let's take the first case where someone stays in the home, which basically means it's self-occupied. So you buy a residence, you are staying in it, which means rental income is zero. So there is no income from this house because you're already staying in it, right? Now, any interest that you have paid on the loan up to rupees 1.5 lakhs can be deducted, can be reduced from your overall income, and that's your income from house property, right? So effectively, your rental income is zero. If you're staying in a self-occupied home and you're paying an interest of more than 1.5 lakhs, then your income from house property is 1.5, negative 1.5 lakhs. This actually gets adjusted right in your income straight away, right? And then basically on the remaining income is what you kind of calculate your income taxation slabs. So that's what happens if you're staying in a self-occupied house. Remember, if you have an income of 10 lakhs and you're staying in a rent in a self-occupied home, and let's say the interest component that you're paying out is 1.2 lakhs, then entire 120 can get subtracted. Your total income on which the tax will be calculated is only 880, 8,80,000, right? If your interest is 2.2 lakhs, then out of 10 lakhs, what is going to get subtracted is going to be 1.5 lakhs, because the max cap is 1.5 lakhs. That gets subtracted. So the total taxation is on 8.5 lakhs. So it actually, if you buy a home taking a home loan, then one of the added advantages of taking the home loan is that you get a tax break on the interest that is paid on the home loan, right? That's if it is self-occupied. Interestingly, if you rent it out, if you rent it out, then there is no limit to the interest paid. If you pay an interest of 5 lakhs a year, that entire limit is available. However, that entire limit is available because there is a rental income. So now there are two cases. One, it is rented, in which case you take actual rent. If it is vacant, then you take what is the municipal rental value at that point. It is deemed to be rent for you. So technically, if you buy a home, that's your second home, you don't stay in it, it's lying idle, no one else stays in it also, there is assumed to be a municipal value of rent on it. It's supposed to be what's called as deemed to be let out. It's a deemed let out home. It's assumed that you have let it out, right? Now, whatever your actual rent is, on that there is a 30% standard deduction, right? So if the rent in the year is 1 lakh, you can subtract 30,000 right away. This is for general wear and tear. General wear and tear, you remove that. So what's left is 70,000. From this 70,000, you can subtract any interest you have paid on the loan, any interest, right? If the interest component is 3 lakhs, you'll subtract the entire 3 lakhs. If it is 5 lakhs, you'll subtract the entire 5 lakhs to arrive at the final income. In this example, that will be minus 2.3 lakhs, right? Remember, if you own a home and it's not rented, it is lying vacant, still it is assumed to be let out or deemed let out. And then whatever rental income is assumed on that, a 30% standard deduction is available. So you take the rent, whatever that rent is. Let's say a home has a rent of 25,000 per month, which will mean 3 lakhs per year. Out of this, you subtract 30% of this, that's going to be 90,000. So standard deduction of 90,000 is available. That's the standard deduction. And the remaining 210 is coming from here. Now from this, if there is any interest, whatever that interest component is, let's say the interest component is 2 lakhs, what is left is 10,000, which will get added to your overall income. If the interest component was 2.5 lakhs, 40,000 would have been deducted from your overall income. That's basically what comes up in terms of the component. Now, generally, you will note that for a home that is valued at, let's say, something like 50 lakhs, the EMI component is about 50,000 per month. So in the year, you're talking about 6 lakhs approximately paid as EMI. Give or take a few, usually you will end up paying a lot of interest on this. So usually the interest payout is higher than the rental income. This works to be a loss from house property, and therefore is a negative number. So in most cases, if you have a home that you have purchased using a home loan, the interest component will ensure that rather than income, you have a loss from house property. When you have a loss from house property, you typically have an advantage because your taxable income actually goes down. Your taxable income goes down, right? That's one of the biggest advantages of home ownership in India, where you can basically purchase a home, and if you purchase it on a home loan, then technically there is a benefit in the taxable income that someone has at the end of it, right? So just to summarize, self-occupied home, zero rental income, you can subtract interest paid up to 1.5 lakhs. That will typically come out as loss from house property if it is a home bought with a loan. If it is rented, whatever the rent earned, if it is vacant, whatever is the municipal value of rent at that point of time is considered. From that, a 30% deduction is allowed for general wear and tear, like painting, breakage, etc., that happens in a home. Subtract from that any interest, no limit on this. Unlike the first case where there's a 1.5 lakh rupee limit, there's no limit here. What comes up is the income from house property, usually again a loss from house property if it is bought using a home loan, right? So home ownership with home loans is beneficial because it gives you a tax advantage. That's the income from house property. Let's take a quick case. And same example that we had earlier, Rajesh is 35 years old. His income is 8 lakhs per annum. Stays in a self-occupied home where he pays 2 lakh per annum as interest, right? Self-occupied, self-occupied. Remember, rental income is, what is rental income? That's zero. And because there's no rental income, there's no standard deduction either. That will be zero. And interest paid on loan, this can be subtracted, but only up to 1.5 lakhs, right? He's paying 2 lakhs, but only up to 1.5 lakhs. That can get subtracted. So your loss from house property is minus 1.5 lakhs. Add this to your overall income. So that's 8 lakhs. What is left is 6.5 lakhs of income. Now 6.5 lakhs up to 2.5 lakhs, 0. 2.5 to 5 is, so up to 2.5 is 0. 2.5 to 5 is 25,000, and 25,000 plus 20% of the remaining 1.5 lakhs, that's 30,000. So the total tax incidence is going to be 55,000 for this person, right? That's the income tax plus obviously the cess that will come in. Now, if he rents this out, if he rents the same thing out, so we put in the rental part. What is the rental income here? We are talking about the rental income being 20,000 per month. So rental income is 2,40,000. Standard deduction 30% of that, that's 72,000. And in this case, the entire 2 lakh goes off. So subtract. 2,40,000 minus 72 is 168 minus 2. So that's going to be a negative of 32,000. We add 8 lakhs to this. Overall income 7,68,000. On this, the tax is going to be 25,000 till 5 lakhs, and then 20% of 2,68,000. 20% of 26.8. 268,000 is going to come in. That's going to be approximately 53,600. 26,800. That's the total taxation. So we're looking at approximately 78,600 into 1.03 for the cess, right? That's the income tax that will come up in case this home is rented at a particular rental income, right? That's how you calculate the income tax on total salary if there is a home ownership that is into question when you're looking at it. Let's take one more kind of income that comes in, which will be the income from profession or business. If you're a doctor, if you're a lawyer, if you're a doctor, if you're a lawyer, there is a professional fees that comes up, or there's a revenue from business that comes up, right? If you're a proprietor of a business. From this, you can subtract any kind of running expenses, and what is left is profits and gains, and this is treated as income. So on this, the entire slab will then work out. Now, what is allowed as running expenses? These are the deductions. So if you're using any assets for business, depreciation is allowed as a running expense. If you're paying any rent for business properties, that's allowed as a running expense, right? If you're using insurance and repairs for machinery and furniture, that's allowed as an expense. Any advertising, business travel is allowed as a expense. So if you're a chartered accountant, if you're a doctor, if you're a lawyer, in those cases, income that you're generating is from your profession. There is no salary that is there. Individuals come and probably pay you, firms come and probably pay you. Then in that case, you're running like a smaller business in a case. And hence, in that context, you are allowed to kind of allow some deductions. Post these deductions, you arrive at what is the income. And based on that, you then go into the same income tax slabs as we have seen earlier. So this is not too important at this point of time. What is more important is the salary part and the income from house property that we had seen. Capital gains is going to be important, which we're going to cover in the next section. At this point, as we come to the end of this particular section, couple of quick questions. Explain the difference between self-occupied and rented house in terms of income from house property, and what are the deductions which are allowed in income from business or profession. Thank you.